All views expressed in this call are provided for informational purposes only and do not constitute investment advice. We urge you to please consult an investment professional before making any investment decisions to ensure that they fit within your risk tolerance and investment suitability. For those of us joining live and the number of you joining us on the replay, thank you for sharing your time with us today and joining us for our Back to School, Back to Basic video series. My name is Jeff Hunter. I'm a portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line is our lead investment advisors, Dave Townshend and Rahim Somani. For more information about our team, please check out mywealthmanager.ca. Today's call is with two of Canaccord Genuity's top metals and mining analysts, Dalton, Baretto, and Carey, MacRury, to discuss the precious metals market and some of their top themes within it. Before we get started, a couple housekeeping items. We have muted participants, but in the chat below, please feel free to direct any questions to Dave, Rahim, or myself, and we'd be happy to ask on your behalf. Today's call will be recorded, so make sure to check your emails in the coming days for the replay information, or follow our Facebook page at facebook.com/mywealthmanager.ca. With that started, Dalton and Carey, can you just provide a little background on your careers and what you're covering so far?
Sure, so maybe I'll start. I joined Canaccord roughly 2.5 years ago now. Previously, I spent about 10 years in equity research at one of the big Canadian banks, basically in the gold equity research space. Started in 2007. Gold was $600 an ounce. Saw the sort of the mid of the last cycle right up to 1900. Saw the bear market that followed after, and lived through the global financial crisis, which I think is a great experience to go through the times that we're living in now. By trade, I'm an industrial engineer, and prior to research, I spent about 10 years in management consulting.
Perfect. Thanks, Gary. So my name is Dalton Baretto, and I'm a managing director with Canaccord Genuity's Metals and Mining Research Group. I've been at Canaccord since 2016, so just over 4 years now, and I've been in the business since 2010. Previous stops include one of the largest bulge bracket banks in the world, as well as one of Canada's big domestics as well. My background's always been on the base metal side, so I've been covering the base metal space since 2010. But a couple of years ago, I got involved in the precious metal side with Carey as well. And so Carey does basically all the large cap precious metals companies as well as all the streamers. And I do most of the mid cap precious metals companies, including the silver names. In addition, I do all the base metals work as well as the commodity work on the industrial side. In terms of background, I'm an engineer by training, mechanical, and I've spent a few years in management consulting like Carey did before entering research.
That's a great background, guys. We get a lot of questions on a day-to-day basis, and I thought probably one of the things to start with is the apparent rise of clients and institutions, investors, chatter in the media, newspapers, and commentary. In your perceptions and in your conversations with institutions and family offices who are looking for advice, are looking to allocate to the sector, what are you seeing in terms of their perceptions of, one, maybe renewed interest, but more importantly, their suggested interest now to enter the sector where they previously had maybe little exposure or zero exposure? And what are your perceptions around what they're saying, and what has changed in your opinion, if anything?
Okay, so maybe I'll start with that. So what's changed? We lived, again, going back to the last cycle, gold peaked out at 1900 in 2011, and then we had a pretty bearish market right through the end of 2015. So sort of 5 years where companies were caught off guard, balance sheets were blown out, companies were slashing dividends, companies were slashing exploration. So the companies were really caught off guard with the last, bear market, which obviously leads to a lack of, we've had this lack of investment in the space, junior financing completely dried up. Companies again stopped building projects. So that's one end of the market where it sort of sets up the next part of the cycle where supply, has now peaked, and there are no projects sort of in the pipeline that are coming behind because nobody's been investing for the last 5 years. So that's going to take some time to turn around. Secondly, again, if you go back to the financial crisis, coming out of the back of that, it was the weakest recovery from a recession in modern times. We had the Fed stop raising rates at 2%, which is unprecedented, and that was in 2019, well before, or sorry, maybe even earlier than that, well before COVID was a factor. I think people came to the realization that not unlike the ECB or the Bank of Japan, we're in this sort of like low rates for longer environment, and when interest rates are that low and inflation is running, even though it's below target, it's running at 1.5%. Your real yield is next to nothing, and in a lot of cases, it's actually negative. So I think the generalist conclusion is that, we are in a lower for longer. And again, this predates COVID. COVID just sort of accelerates what's already been happening. And then, if you want to protect your wealth, if you're going to own, treasury bonds or corporate bonds that are earning next to nothing, gold is a good alternative. So I think the interest in gold has been rising for the last few years. We are in this low interest rate environment. And then we've basically got massively rising debt levels. So it'll be interesting to see. The one other point I would make is that, I think the Fed, it's clear now, and listening to Jay Powell back in December, they've realized they've undershot or overestimated inflation, right? They thought as, unemployment keeps ticking down, inflation must be around the corner. Inflation's been at their target 13 months out of 10 years. So clearly, or 11 years. So clearly the model's broken, which is now why they're pivoting towards, let's really see inflation happen before we, take our foot off the gas. So we think, the foot's gonna be on the gas. The target for the Fed is higher inflation. This weak economy we're in with debt levels where they are, they sort of need that to happen. So I think that's the sort of bigger picture, how we got here on gold.
Oh, those are great comments. And, a little spin-off on that is if we do get that target of inflationary pressure, some of the companies and the CEOs that you deal with, where in their inputs would that inflation be felt? Would it be on the mining side? Could even be towards getting good talent. Where does the cost structure, in your opinion, when you're looking at these types of companies or the sector overall, what should investors be pinpointing from your point of view as something to be aware of?
Well, I think the gold industry is actually in a pretty sweet spot right now. Again, going back to the last cycle, 2001 through 2010, 11, it was a bull market for every commodity, right? Gold was going up, copper was going up, iron ore was going up, oil was going up. So everybody in this entire mining space was building, buying, hiring geos, hiring engineers, consuming steel. So it was sort of a, everybody was sort of running through the same door at the same time. And, obviously the cost inflation was rampant. Obviously we're still relatively early in the cycle, but oil is at $38. Most input costs are pretty weak. Again, the industry, I think, has learned lessons from the past cycle that, growth is sort of off the table for a lot of players. Nobody's massively building projects. Everyone's pulled back. Everyone's sort of very cautious. So we're certainly not seeing cost inflation. I think we're going to see two areas in cost inflation in the short term, but both are pretty benign in the fact that, we're at a $1,900 gold price. So one is royalties, right? So obviously the higher gold price, that's going to, translate into higher royalty costs, which isn't a big factor overall. But secondly, I think, the Fed, if you think about what they're trying to do with monetary policy, they're trying to take the US dollar down. So we're going to see currencies, Canadian dollar, Aussie dollar, some of these producer countries are probably going to go up over time, which is going to impact some of those producers.
Jeff, you had a question as well?
Yeah, so just with that, and we've seen a number of the major acquisitions last year. It's been comparatively quiet, mostly smaller in size. Do you attribute a lot of that to the COVID world, or is it a lot to do with those acquisitions like the Barrick Newmont just being so much bigger? And do you see a really big M&A market in the months ahead or even years ahead?
Yeah, no, I think M&A is still going to be a pretty big thing going forward. Now, I think the Newmont, Gold Corp, Barrick, Randgold, those mega deals, those are sort of few and far between. I don't think necessarily we'll see more of that, but I do think we'll see continued consolidation at the mid cap, small cap space. And maybe Dalton can chime in here, but the types of deals we've seen, Endeavor, Semifo, Equinox Gold. I think there's a recognition that having a bit more scale at that level, is what investors want, and getting more sort of index inclusion. To be a single asset producer has sort of gotten out of favor for a lot of investors. I think we'll continue to see that. Now, what we haven't seen yet is the developer M&A. Again, most of the mining companies have so far been very, very cautious about building anything of any sort of greenfield. So we haven't seen that yet. And what's going to be the catalyst to get to see that? Well, I think at this point, investors still prioritize free cash flow over growth. I think that will change as the cycle gets a little bit older. People will start to pivot back to growth. Secondly, cash balances. I mean, if you look at our coverage universe, it's generating at $1,900 gold, $18 billion of free cash flow, and they're paying out about $4 billion in dividends. So that's $14 billion of cash flow is going to start piling up, which begs the question. Yes, some of that will go back into dividends, but there's clearly going to be a lot more financial firepower to start doing developer M&A, I think. I don't know if Dalton, you want to chime in?
Yeah, I'll piggyback on a couple of things you said, because they're absolutely true, right? And the key to the answer to your question, Jeff, is, do these mining companies have license from their investor base to go out and basically deploy the balance sheet, right? And so we're so early in the cycle right now that there's still a bad taste in most people's mouth from the last cycle, right? And so the conversations we've been having with investors since the March lows, and even before that, has always been around free cash flow. Who's generating cash flow? Who's generating cash flow? And then as valuations started to run, it became free cash flow yield, right? So it's a combination of the two. But then that conversation started to peter out when everyone was generating free cash. And now the conversation is starting to rotate back to growth, right? Until now, from an M&A perspective, the only license that these management teams have seen are what Carey alluded to in terms of these mergers of equals, because they make sense from a couple of perspectives, right? A, you're not blowing up the balance sheet. B, you're spreading your corporate cost and reducing your portfolio risk. And C, you get the scale to get you into these ETFs or to get you into some of these larger funds, so you get the valuation bump. Now we're getting to these conversations around growth, but they're still very much kind of in pipeline growth. So what do you have in your pipeline right now? I suspect come next year, that conversation is going to move to the M&A side of things. And I think probably mid to late 2021, if the gold price stays where it is, or if it accelerates, is when you're going to start to see the developer M&A again.
Perfect.
And just maybe I'll just add one more point on that. I do think, again, I think in the producers, they've lived through the pain of the last cycle. I think they've realized that, merger of equals and lower premiums, they're willing to accept that. I'm not sure developers have sort of come to grips with the big premiums of the past cycle are probably behind us. Not that there won't be a premium, but if you look at the M&A in the last cycle, there was a lot of write-downs. People overpaid for assets, and given the run-up in gold price to 1,900, I do think price expectations for juniors are probably higher than what the seniors want to pay for them. So there will be a bit of a buyer's war or bidder's war.
It's Dave here. Just a quick question on the metrics. I've been here since gold was $300. So now looking at gold at, arguably 2,000, what's an ounce of gold in the ground worth? What are everybody modeling? So if we're looking at this, retail at the banks and retail generally is kind of in the gold market. They're kind of interested. They're buying the ETFs. They're not in single securities. So you guys as analysts, right? What do we think an ounce of gold is worth in the ground in North America? Like my focus has been to look at, you guys have done excellent work in design in as a group in pointing out these MOZ, like the stuff in Newfoundland, like, domestic resources that should be bought up, in my mind, as the producers, as their cash piles up, they're going to buy reserves. So like, where do you guys come in as a group? You know, what's an ounce of gold in the ground worth today?
Well, I think the first thing I would say is it completely varies, right? Depends on what country you're in, what stage of the project. I mean, not all projects are created equal. There's, you know, if you go to some of the M&A we've been seeing, you know, you look at what Kinross did this week, they bought Peak Gold. There's an asset that's sitting in Alaska. They don't have to build a mill. They can truck it to their mine. Yes, it's 400 kilometers down the road, but it's also 6 gram material. So that asset's worth a lot to Kinross, probably not worth a lot to anybody else because, you know, someone else would have to go and build the infrastructure. You look at the deal that, you know, Teranga did for Massawa in Senegal. You know, Barrick had a high grade 4 gram, 5 gram deposit 20 kilometers down the road from Teranga's Sabodala mill. Why build a duplicate set of infrastructure? So I think the M&A we've seen so far has been logical. There's actually real synergies. You know, why, again, in the past cycle, it was always build and build as big as possible. So I still think as long as those opportunities are out there, and again, I think the industry is very cautious. They're going to be very cautious on buying development assets. Yeah, you know, I do think it will come at some point. You know, just coming out of Denver conversations last week, right? The Denver Gold Show. A lot of management teams are still pretty agnostic on the gold price, right? There's the view that, you know, the reason we're at 1900 is because of COVID. And if we get a vaccine, we're going back to 1300. Like the whole conversation about capital allocation, these guys aren't ready to believe in $1,900 world. They're running their business like it's $1,200, right? So from that lens, are developers willing to sell their assets with a $1,200 or $1,300 gold price in mind? So I think there's this discrepancy in the industry, and the seniors, it's discipline all day long at this point.
And Dave, another point I want to make is you stress the word domestic here. Yeah, Canada's got lower jurisdictional risk, but there's a lot of hair that comes to Canadian projects too, right? I mean, they're generally lower grade, and permitting's a nightmare in this country, right? Compared to somewhere like Chile, for example, right? So there's that aspect of it as well, right? I mean, can you actually take these things through the permitting process in a reasonable amount of time? You know, can you get your social license? These types of things are important here as well, right?
Just a question here on when you in your coverage universe and with respect to companies you're going to cover, and this is more of a client type of question to ask, and when they're looking through the universe of companies to invest in, what gets you excited about a specific type of company? Is it the management team that you give a certain amount of credence to? Is the deposit the most important thing? Obviously, jurisdictional risk goes without saying, but there are some very exciting projects always globally, maybe not in the best jurisdictions or traditionally the best. What are the components that help you put together that company that represents a star of the future? What are those elements that you guys are analyzing that puts the equal sign and you put a check mark beside that?
For me, I think for me,
yeah, go ahead, Carey.
Yeah, for me, I would say, the top two factors, number one, definitely is management track record. Have they done it before? Do they do what they say? Do they have the technical team to execute? And then secondly, I would say, it's easy for analysts to model out, a company puts out a PEA or puts out a feasibility study, and we can look at the model and we can say, okay, great, it's worth X. But it's really how can these guys execute, and what's the degree of risk and execution? So in that point, it comes down to geopolitical risk. It comes down to social license. So do they have the communities on board? You sort of go through the list of all the things and you check off sort of the boxes on how is this thing going to blow up. And if you can get through most of those boxes, feeling confident that the end game is potentially doable and the valuation is reasonable, I think for me, that's the way I think about it.
Yeah, and I agree with Carey, but to me, those things are all table stakes, right? If without a solid management team, with a proven track record, without a project, that has a decent address, that has decent relationships in the area, that has decent material in the ground, we're never going to put an output form on it. Now, Carey and I cover mostly kind of mid and large cap producers, right? So these assets, by and large, are proven for the most part. They're for the most part, they're operating, right? And so it's also a function of where we are in the cycle, right? Are investors looking, do we believe investors are looking for growth? In which case, some of our growthier companies, I think, would be ones we would point to more as, tending to outperform over the next 6 to 12 months, right? If we're in a more defensive phase, it's free cash flow that we look at. So there's a number of other factors that go with it, but absolutely, management teams and projects or asset quality, that's table stakes.
Yeah, just using your analysis, can you give us some ideas of what fit that bill right now and where you like to see, or good examples of companies that are following that discipline and are taking advantage of the track records, what's in the ground, and running their company prudently?
Absolutely.
Yeah, so I think you want to go first. I want to go first.
Yeah, okay, yeah. So I was just going to talk about Equinox here because this is one that really checks all the boxes for me, right? You've got the company being steered by Ross Beatty, who is a legend in the mining space with, definitely a proven track record, right? You look at the companies that are the names that are on that company's shareholder register. You've got Lucas Lundin in there. You've got Richard Rourke in there. You've got Frank Giustra in there. You've got Peter Maroney in there. So you've got the board and the shareholders that believe in this company. You've got a management team that's all worked together in the past at Endeavor Mining, built a very strong company. So you've got that. And then, as I mentioned earlier, you've got a lot of investors starting to pivot towards growth, but growth that you own right now that you don't have to go out and buy. And when you look at Equinox's development pipeline, it's by and large the best one out there. These guys are going to double production. They're 500,000 ounces this year. They're going to be at almost 1 million ounces in, just over 2 years. And all of that growth is funded. I mean, they've got the balance sheet to do it. It's low risk growth because there's nothing greenfield in there. They're expansions and project restarts. The geographies are, what are, I would call, typical for precious metals mining. So Mexico, Brazil, the US, places like that. And they've got catalysts, which is another thing that's important to investors. Can you see some news coming down the pipe that you think will move the needle? And these guys have it, right? They've got new technical reports coming out on all of their growth projects between now and the end of the year. So this is one that, I find very compelling, and I talk to investors about a lot.
For me, I would maybe start with Kinross. So, if I think about where we are in the cycle, Newmont and Barrick is the biggest names that sort of outperformed in the early part of the cycle, but now they're at a point where they're relatively expensive. They don't have a lot of growth. So a name that I like a lot is Kinross. So in terms of track record, I think institutional investors like the management team. They've delivered. I think they've met their guidance 8 years in a row. You saw probably the news last week. They reinitiated a dividend after 7 years. They've gone through a cycle of investment that they're coming out of. So they're really new to the free cash flow story, and I think that's going to sell pretty well. If you look at what they did in 2019, they pretty much broke even on a free cash flow basis, again, as they were investing in the business. But into next year, we have it going to $1 billion and potentially to $1.8 billion beyond it at current gold prices. So the market, for companies that have really had that sort of free cash flow transition story, I think it's a story that people like to see. And I still think we're in a bit of a show me market for most companies. So I think as they deliver that free cash flow, and again, it trades at a big discount to the Barricks and Newmonts of the world. So that's one I like on the senior side. Another name I would point to would be Teranga, as I mentioned. They're sort of, I would say, a smaller name off the radar, but the asset they bought from Barrick Misao, it's like 4 times the grade of what they're putting in their existing mill. The execution risk is low. You're literally mining a deposit 20 kilometers away, trucking it to the mill you already own. This thing is going to go from doing, historically did about 250,000. It's going to take it to like 500,000 ounces in the next 18 months. And with 3 times the grade brings down your cost profile. So the free cash flow profile of this company is pretty huge. And, in my numbers, it trades at something like 3 times EBITDA in 2021. So I think it's one where as people see the growth in production, the growth in free cash flow, they're going to be able to pay down debt quickly. I think it's one that's got a lot of catalysts for it in the next 12 months.
Perfect. Raheem, Dave, any questions?
No, for me, I'm just looking at this as the sector ever. I really find it difficult to remember a time in the last 30 years where the sector looks so attractive. You know, you're talking about things at 3 times cash flow. Like, these are unheard of. So I guess for me, I look at this and say, you know, as one of you pointed out before, as long as there's no blow up, what can go wrong? Like, the price can collapse, but where do you think where do you think that you know, where are the landmines here? I guess
well, this is, again, I think this is exactly the time of the cycle you want to be in the sector, right? I think there is a residual perception that the sector, you know, I talked to generalists who said, I haven't looked at the sector since 2011. What's changed? Well, a lot has changed. Balance sheets are better. Cost structures are lower. Companies are making record profits. The 2 biggest ways companies blew up in the last cycle: overpaying on M&A and building projects that either you thought was going to cost $1 billion and ended up costing you $2 billion or $3 billion, or you thought was going to produce, you know, 500,000 ounces and it produced 300,000 ounces. Nobody's building those projects today, and nobody's doing big M&As. So I think the industry is very disciplined, and I think it just takes time. I would say that, look at the classic gold stock right now, Franco-Nevada, trades at like 3 times NAV, whereas the producers are trading at 1 times NAV or a fraction of NAV. Why does Franco get a big premium? Because it's got a huge track record. People trust it. It's got a 20% CAGR since its IPO in 2007. It's outperformed 9 out of 10 years, right? And it's a company that's raised its dividend 13 years in a row. So I think that demonstrates there is an appetite to own companies that can deliver and, you know, that have gold exposure. The mining companies are still new, or at least the perception of investors are still, you know, hesitant to jump in because, again, they remember the last cycle. So I think, to me, that smells like, you know, early stages of a bull market, right? People are still not jumping in yet. So I think I take that as a bullish sign.
Yeah, in terms of landmines that I see, I don't think it's the mining companies, like Carey said. I think it's stuff that's out of their control. Dave, you talked about the commodity price. Yeah, absolutely. But it's also, you know, in every cycle you see this, when you've got a massive rally in the commodity price, you tend to have people with their hands out. So you've got governments around the world with really stretched balance sheets right now. So that's one risk right there, right? Royalty and tax rates. You've got indigenous groups that, you know, basically see companies making a lot of money off their land. You know, typically there's renegotiations of contracts, and so we're starting to see that now. You know, then you've got the workforce in unions. You know, just over the past week, I've seen 3 unions go on strike. Right? So it's stuff like that. You know, when companies start to do well, there's a lot of stakeholders that, you know, want to rewrite their contracts to try and participate in the upside.
That's good commentary, and that probably alludes to common characteristics of all companies. Probably not analogous just to metals, but oil and gas. I think a lot of people will be familiar with that. It runs the same parallels. A question on base metal pick, because we have expertise here. You know, what thoughts in the space, and you know, what's the name that sticks out for you?
Sure. Yeah, it's not a great day in the base metal space today. The copper price is down 5% as of this morning. So, but you know, it's a healthy correction, right? The industrial commodities have done really, I think, better than anyone expected them to, just given what was happening in March and April. But once again, you had, you know, just like in 2009, you had China step on the gas. You know, you had the stimulus all over the world dropping currencies, and you had the industrial commodities outperform. The one that's performed the best this year, iron ore, because you had a lot of steel-related infrastructure being targeted with stimulus out of China. At the same time, you had Brazil, which is the 2nd largest exporter in the world, have massive issues with Vale, right? And that's on the COVID side as well as on the execution side. So iron ore has done really well. You know, I think it hangs in here for at least a little while. So a name like Champion Iron is one that I would definitely look at. It's, you know, it's underperformed relative to where it should be, given what the iron ore price has done. You know, and it's a good, solid company. It generates a ton of cash. You know, it's got a very prudent management team. So that's one to look at. On the copper side, I think we're there. Somewhere between 285 and $3 copper is probably a fair value for where the market is right now. I don't see $4 copper on the horizon anytime in the next couple of years. There's a lot of production that's coming online, and I don't think you'll see demand respond as quickly as supply has. You get a lot of supply shut down due to COVID. That's all pretty much come back online right now, and you've got new projects in the pipeline. So I think we're pretty much there. So on the copper side, you're looking for names, not necessarily with torque to the copper price. You're looking for names with good fundamentals that actually have catalysts. So names like Hudbay Minerals or Capstone Mining, right? The other one I really like is Teck Resources. It's got a diversified portfolio, but it trades like a met coal stock. And met coal probably has the best fundamentals out of any of the industrial commodities I cover, because it's been beaten down so badly because a lot of its end markets, its biggest end markets are India, Europe, and China. And China's bounced back well, but it imports very little. India is the biggest importer in the world, and they're only just starting to get their steel production back online. And so you should see the met coal price bounce back fairly substantially over the back half of this year, and I think you'll see tech do really well on the back of that.
Just on that, and really the lack of investment in all commodities generally over the last few years, do you see any other potential supply shocks that are significant on the horizon in any of these major spaces? And is there some areas that get a lot of excitement and attraction to that maybe you should just be a little cautious on, that don't quite have the fundamentals for that longevity?
Well, I'll address that last point first. And silver is one that had a massive rally over the last couple of months. It's pulled back a lot, and it should, because silver is one of these names that it tends to lag gold and then just massively outperform. It overshoots and then it has to correct, right? But it's one of those commodities that doesn't really have the fundamentals to back up what the price trajectory has been, and so that's one I tend to stay away from in kind of the near term. The other one, zinc, right? Zinc has a lot of supply that's scheduled to come on over the next couple of years. And so the fundamentals of that market will change dramatically. And so, I'd be staying away from, frothy zinc stories.
Great comments, gentlemen. Great comments. The price of oil here is always the topic of conversation in Calgary. And what do you think this has added to the bottom line of the big miners to have crude below $40?
Well, normally energy costs tend to be, and energy costs can come in two ways. You've got your power cost to, to feed these big mills, and you've got obviously your truck fuel costs. So depending on the type of mine you have, and if you're on grid power or running diesel, but certainly for mines that are running, diesel power off the grid, it's a huge win. I mean, you would think that 15 to 25% of their costs would be probably fuel related. So you can just do the math on that front. But it's difficult to, a lot of these guys are pretty diversified and have a range of mine, a range of types of mines. So the impact is difficult. The other thing I would say is the industry does hedge oil often. So it wouldn't surprise me that some of the hedge books are still at, $40, $50 oil as opposed to $30 oil. Now I assume they're probably adding to their hedge books as we speak, but it's difficult to see directly, there's no sort of one answer. It depends on really the company and the type of mine they're running.
Yeah, the other thing I'll add to that is the exposure to oil prices is usually a function of scale and geography. And so as you guys know in Alberta, the oil sands, with the trucks and so on, you have massive consumers of oil, right? The corollary to that in the mining world is the iron ore and met coal mines, because these are usually on a scale that's orders of magnitude above, copper mines or gold mines for that matter, right? And so those commodities are far more exposed to oil prices. And again, I'll come back to tech, right? It's, energy is 40% of its cost, right? And so being able to hedge that out, and that's one of the reasons they invested in Fort Hills, right? Because they were so short the oil price for their coal business that, they wanted to, at the very least, offset that in some way by taking out some long exposure to oil.
I have a couple questions, and then it's it for me, but these are more client type of related questions. And We have a big Canadian clientele. It's not just relegated to Alberta, and we have a number of global clients as well. Topic that keeps coming up with a number of new clients that keep joining us, and something that maybe you guys can comment on, is the effect of environmental and social governance as a topic of investing in certain companies. Are you seeing that conversation arise, and is it something that is becoming more common towards mining companies, and specifically how are companies positioning themselves? You alluded to earlier that, you know, stakeholders become a rising, I don't want to say a hurdle, but it starts to affect how the business maneuvers as it scales. So what are your thoughts on that? And then I have one last question after.
Do you want to handle that one, Dalton? Or?
Yeah, sorry. The short answer is yes. It's a topic of conversation in every single meeting with every single company. On the institutional side, there's, you know, it's massive, to the point where the mining companies are rebranding themselves. You know, you look at Ivanhoe Mines, you know, they've changed their branding from being, you know, the best copper mine in the world to the greenest copper mine, right? It's a topic of conversation that happens all the time. You know, you've got the Norwegian Sovereign Wealth Fund that won't invest in oil anymore. It won't invest in coal anymore. You know, Teck is taking a serious look at its coal business because, you know, it trades at a massive discount because a lot of guys won't touch the stock, right? And so, yeah, it's a topic of conversation for sure. And it really takes two forms with the institutional investors. Some of them have a dedicated ESG team. And so when mining companies go in to meet with the portfolio manager, there's typically an ESG person sitting right next to them that will have their own kind of checklist of questions and conduct their own evaluation. And the other big form is basically checklist. So the portfolio manager will maybe like the fundamentals of the company, but they'll have a checklist and they'll have to tick off, you know, where this company meets or doesn't meet the internal criteria. And that's a hurdle that they have to jump over to basically invest in these companies. And it's a pretty high hurdle because the ESG movement is still in its infancy. And so the checklist that these ESG teams create, or even it's just the ESG people themselves, they're typically general checklists, so they're sector agnostic. And when you've got a sector agnostic checklist, that always puts the extractive industries at a disadvantage, right? And so there's a lot of work being done to kind of change that perception. You'll see every single mining company now, or every single one that can, put out a sustainability report. That never used to be a thing, but that's definitely a thing right now. And they'll host calls. So in addition to their investor day calls or their annual general meeting, they'll have a dedicated ESG focused call to talk through some of these issues, right? They are contracting to third parties to create frameworks specifically for the mining industry that can be used across the board that, you know, tell the story a little bit better, right? So yes, short answer, it's a massive topic of conversation right now.
Fascinating. Maybe you should all look at becoming ESG consultants. The last question I have, and a little bit more macro, but it is tied to mining companies as they move forward. Zero interest rate world, traditionally growth that builds cash flow picks up. You alluded to Franco-Nevada having a great dividend policy and rolling dividends and increasing them annually becomes an expectation over time, I think, when you build that mindset. The industry as a whole traditionally is not a big dividend payer. Do you see this as becoming a big ask for the majors to be able to start to allocate free cash flow? Because most client portfolios, fixed income is just a hedge now with a lot lower returns if you're overweight in that direction. So income and growth investing, I think, is going to start to come on again. But it would be interesting to hear your point of view.
Yeah, no, I think absolutely that's probably the single most topical thing on investors' minds, right? We just went through the Denver Gold Show, and I think every company who has a dividend or can pay a dividend, it's probably the first question is, what are you going to do with the money? So again, on our numbers, you know, our coverage universe at these gold prices is generating $18 billion of free cash flow, and we're currently paying out about $4 billion. So that leaves a big number to allocate. Now, what industry wants to do is they don't want to do what they did last time. They jacked up all the dividends, and then the gold price fell, and then all the dividends got slashed. So dividends were almost $4 billion in 2011. By 2015, it was 600 million. So there was, it fell 75%. So it is a cyclical business. These companies are obviously aware of that. And what they want to do is set a dividend at 12 or 1300 that they can pay, presuming that gold goes back to 12 or 1300 as opposed to slashing the dividends. But that is going to lead us to a problem, right? The money is going to start to pile up. So then it comes, what do you do next? Do you invest in growth? Do we end up in some sort of scenario like I think tech has sort of a base dividend, and then you have a special dividend, or maybe you have a base dividend and a share buyback? But the industry hasn't figured it out yet. I mean, every management team that I talked to last week, that questions came up, and there's still a disbelief, I think, in the industry that gold's going to be 1900 a year from now. I wouldn't say that's universal, but I would say that's at least more than 50% of the people. So it is a topic that people are going to continue to talk about. I don't think the industry has an answer yet. The cash is going to have to be dealt with at some point. But I think the general view is, I think what investors really want is just disciplined capital allocation. Whether you keep the cash on the balance sheet, slowly increase the dividend, do share buybacks, they just don't want to see, again, splashy M&A, big project investment. As long as, I think discipline is the key word, I think that's what investors are really looking for, but we'll have to see how it plays out.
Perfect. Dave, Raheem, any last comments? I think we're just getting to the end of this right now.
Nope, I'm good here. You guys answered those questions phenomenally, so thank you.
Maybe I'll just chime in with one more thing that's topical. People talked about, the Warren Buffett investments come up a lot, and, people sort of got in a tizzy that, how can Warren Buffett be buying Barrick? If you read his historical commentary on gold, it's really around gold, right? He's made a point of, if I own an ounce of gold today, 10 years from now, it's an ounce of gold. I think his point was gold's not a productive asset. Now, if you read his 2011 annual report, his letter to shareholders, he talks about realizing the world we live in is very similar to today. You had almost 0% interest rates, owning an asset where you're hedged against a declining dollar. And his point is like that saying you guys have probably heard, return-free risk. If you're owning a 10-year treasury that's giving you 0.7%, and the Fed's telling you their job is to, take interest rates back up to normal, well, what does that mean? That means that the 10-year treasury that you buy today is going to decline 20% in value, and that's your risk-free asset. So you're going to get 0.7% yield with the risk of losing 20% on a, safe asset. So I think he gets the macro picture, and I think that, the example I would use is like oil and oil stocks. He's bought oil stocks because they're a business, they generate cash flow, they pay a dividend, but he probably wouldn't buy oil that's going to sit in a warehouse for 10 years. So I think Barrick, and he probably, I would imagine, buys into the Mark Bristow, strategy of gold companies are gold companies to run a business. They're not there to grow gold. They run a business, create money, pay a dividend. And I think that generally, I think you could buy into that.
Perfect. Thanks very much, Carey, Dalton. We really appreciate your time. Dave, Raheem, anything else? Yeah, thanks very much for your time on this lunch hour. We really appreciate it. And I know everyone really enjoys listening to your guys' view on the sector. I think it's a really exciting outlook on it. And for everyone, check your emails in the coming days. We'll be reposting this and sending this out to you. And if you have any questions or comments just regarding your investments or your strategies and finding the solutions within them, please reach out to us. We're more than happy to discuss and sit down and find new ways to grow your capital. Thanks very much.